In 1972, investors crowded into superstar stocks, convinced safety was found in numbers, until the market lost nearly half its value as those leaders fell. Today, NVIDIA stands at the center of a similarly concentrated bet, smashing records as over 50% of S&P returns hinge on just a handful of names. History says this pattern can be fragile, but what actually tips leadership from unbreakable to exposed? The answer may look different than you think. In the early 1970s, the S&P 500's biggest gains came from a surprisingly narrow group. About a quarter of the entire index's returns in 1972 could be traced to a handful of celebrated stocks, soon to be known as the NiftyFifty. These were not just household names. They were treated as financial royalty. Companies like IBM, Coca-Cola, Avon, and Polaroid were described by star managers as one-decision stocks. The logic was simple. Buy them, hold them, forget the price. In a 1972 interview, Fidelity's Jerry Tsai summed up the mood. Quality compounds eternally. Forget the price. That mindset did not just belong to a few optimists on Wall Street. Across the market, investors piled into these leaders, convinced that their growth, brand power, and steady earnings made them immune to downturns. The numbers backed up the confidence, at least on paper. The average price-to-earnings ratio for the NiftyFifty soared above 40, with some trading at 60 times earnings or more. By the end of 1972, the top 10 stocks alone accounted for roughly 25% of the S&P 500's total return for the year. This was not just a bull market. It was a market led by a small, exclusive club. The NiftyFifty label became shorthand for invincibility. But as history would show, even the brightest stars can lose altitude when the environment changes. NVIDIA now sits at the heart of the S&P 500 in a way that would have stunned even the most bullish investors a decade ago. Today, the company alone accounts for about 6 to 7% of the entire index's weight. In 2024 and 2025, NVIDIA and its fellow tech giants delivered more than half of the S&P 500's total returns, a level of concentration not seen in generations. This isn't just about market capitalization, it's about how money moves. When NVIDIA's price rises, its weight in the index increases, and that triggers billions in new inflows from passive funds and ETFs, which are programmed to buy more of what is already winning. In May 2024, after a blockbuster earnings report and a wave of bullish options activity, NVIDIA's stock exploded in volume. Over 500 million shares traded in a single day. ETF inflows topped $10 billion in the days that followed, pushing NVIDIA's weight even higher. The effect is self-reinforcing. Price goes up, index weight goes up, more money chases the leader, and the cycle repeats. This feedback loop can make leadership feel bulletproof, but it also means the entire market becomes more sensitive to what happens with a single name. If NVIDIA stumbles, the passive flows that once lifted it could just as easily reverse. The structure itself amplifies both the gains and the risks. Concentration isn't just a story about big winners, it is a system that can magnify swings across the entire market. The next question is what happens when everyone's expectations and the price hinge on growth continuing at this scale. By late 1972, the market's faith in the NiftyFifty had crystallized into numbers that still raise eyebrows. The average price-to-earnings ratio for these stocks did not just nudge past historic norms, it soared to 40, 50, even 60 times earnings for the biggest names. Polaroid, riding a wave of instant photography hype, traded at a staggering 90 times earnings. Investors were willing to pay nearly a century's worth of profits up front, convinced that growth would never slow and that these companies had discovered a formula for perpetual expansion. This was not just optimism, it was a bet that quality alone could outpace any risk, including rising interest rates. The logic seemed airtight. If a company could grow earnings at 20 or 30% a year, why worry about what you paid today? But the math behind these valuations was quietly fragile. The higher the price, the more those future earnings depended on the world staying stable, on inflation staying low, on discount rates staying anchored. and on competitive threats, never materializing. When rates rise, the present value of distant profits shrinks fast. In 1972, few investors ran that calculation. The focus was on growth stories, not on how a shift in the cost of money could cut a stock's value in half. Extreme multiples made the NiftyFifty look untouchable, but they also set up a market that was more exposed than it seemed. NVIDIA's current valuation is built on a towering set of expectations. At a forward price-to-earnings ratio above 60, the market is assuming not just strong growth, but something close to perpetual acceleration. The company's most recent quarter reported $57 billion in revenue, with a full-year guide of $170 billion. Those numbers would have sounded impossible even to insiders just a few years ago. Jensen Huang, NVIDIA's founder and chief executive officer, has described demand for the company's Blackwell chips as off the charts, with hyperscalers and cloud giants racing to secure supply. But the math behind the price is unforgiving. At these multiples, over 80% of NVIDIA's current value is tied to profits expected 10 or more years in the future. That makes the stock extremely sensitive to changes in interest rates. If real yields rise by just 200 basis points, discounted cash flow models show the present value of those future earnings could fall by 35% or more. On paper, that is hundreds of billions in market capitalization. The company's revenue growth has averaged over 60% year over year, and the market is pricing in continued compound annual growth rates above 35% for the rest of the decade. These are extraordinary numbers, but they leave little margin for error. The higher the valuation climbs, the more even a small disappointment in growth, margins, or demand can ripple through the entire market. NVIDIA's leadership is built on real innovation and execution, but the price reflects a story where nothing can go wrong and where the future is already bought and paid for. That is the kind of setup where regime risk, the possibility of a sharp change in rates, policy, or competitive dynamics, can have outsized effects, not just for NVIDIA, but for every portfolio tied to its fate. In August 1971, President Nixon appeared on national television and announced the end of the dollar's convertibility to gold. Overnight, the world's financial anchor slipped, and the dollar began to float. Within days, Treasury yields jumped, and the cost of capital shifted for every stock on Wall Street. High multiple favorites like Xerox and Polaroid saw their share prices drop 5 to 10% in a matter of hours. The shock did not stop there. By October 1973, oil-producing nations imposed an embargo, sending energy prices soaring and inflation into double digits. The Federal Reserve hiked rates, trying to contain the fallout, but the damage was done. From January 1973 to October 1974, the S&P 500 lost nearly half its value, down 48% from peak to trough. The NiftyFifty, once thought immune, fell 60 to 70% from their highs. These were not failures of business quality. They were the result of a new environment, one where the rules investors had trusted no longer applied. Breadth in the S&P 500 now sits below 50%, meaning fewer than half of stocks are rising with the index. That's one of the oldest signals that leadership is getting too narrow. When the top names drive nearly all the gains, the market's cushion thins out. Margins matter too. If NVIDIA's gross margin drops below 70%, or if earnings guidance starts to miss the pace of price moves, those are early tremors. Watch for insider selling. When executives cash out at record levels, it is rarely a vote of confidence. ETF flows tell another story. Inflows can push a leader higher, but outflows can pull the rug out fast, especially when index funds are forced to sell, a pause, or cut. In hyperscaler capital expenditures, big buyers like Microsoft or Amazon slowing their spending can ripple through the entire AI trade. These are not predictions, just signals. When several start flashing at once, the narrative of safety gets stress-tested in real time. Market leadership feels permanent, then a shift can make it fragile. Today, over half of S&P 500 returns depend on just a few stocks. History shows concentration amplifies both reward and risk. The real test begins when the narrative meets reality. Which story wins? That is still unwritten, Share your take below.